If the politics forces the interest rate to decline, then you'll see gold rip. The Chinese are building an alternative system for trading gold, taking control of the gold trade out of COMEX and out of the LBMA, at least partially, democratizing markets for gold, creating more markets for gold. I hope that the Chinese will be more open to allowing foreigners unimpeded access to their gold market. And I suspect about half that paycheck will go into physical gold. And I'm pretty price insensitive, Daryl.
Equities they've fallen dramatically, and then we've had a big rally.
I think there's a discussion going on behind the scenes from people who believe that the interest rate should be set by the market. The idea that either the economic oligarchs or the political oligarchs would allow this to happen in isolation without taking into account their interests, I think is problematic. I think, too, unfortunately, that the vast majority of American voters are more concerned about the level of their car payment and whether or not they can buy a house. I think what you're seeing on the long end of the yield curve is the market beginning to reassert control over the Fed.
Gold and silver have began to move up. Are you viewing this as a short-term bounce, or do you think something more fundamental is at play, or maybe the debasement trade is back on? Just curious in how you're viewing this.
I hate to admit it, but I have no earthly idea, Daryl.
Yeah.
I believe that the gold prices we've talked about for a long time will do very well over the next 10 years. I think the next 3 or 4 months could be problematic. If the interest rate, the nominal interest rate, continues to increase, that should, if it continues to occur, continue to strengthen the dollar. Gold is denominated in dollars. And it also, because of foregone interest rate, makes holding gold more expensive. In the near term, a rising interest rate, if it continues, should be hard on the precious metals print. I think what you're seeing in the gold market in the very near term is people who are increasingly believing that despite the fact that there is political pressure to allow the interest rate to rise, there's more political interest in suppressing the interest rate. And make no mistake, if the politics forces the interest rate to decline, if we send a signal to the market like we sent to the market in 1975, that short-term American politics are more important than the sanctity of the U.S. dollar, then you'll see gold rip. Now, whether or not that happens or not is anybody's guess.
How are you looking at China with the Shanghai Gold Exchange and getting rid of a lot of the paper trading against gold and defending the average people who buy gold in those regions from like these volatile price swings and things of that nature? How are you viewing that?
The biggest risk to gold may not be higher rates. It may be the political pressure that eventually forces them lower. Rick Rule notes that gold can face near-term pressure from rising nominal rates, yet the larger danger is policymakers deciding the dollar's credibility is negotiable. That creates a dangerous asymmetry. Temporary weakness could become the setup for a much larger repricing. For savers, the issue is not predicting next month's gold price, but surviving policy reversal without losing purchasing power. Next, Rick Rule exposes what happens when politics overrides the dollar's supposed discipline.
I think any interference by a government in markets is a bad thing. But I do like the fact that the Chinese are building an alternative system for trading gold, taking control of the gold trade out of COMEX and out of the LBMA, at least partially, and democratizing markets for gold, creating more markets for gold, is, I think, a very good thing. I think the LBMA fix, as an example, is an anachronism that really benefits nobody except perhaps the member banks. And I think the whole system that we have in the United States with regards to COMEX metals futures could use a competitor. If the Chinese have decided to do away with paper claims and merely honor deposit receipts or physical gold, I think it would be great to let the market decide. I hope that the Chinese will be more open to allowing foreigners unimpeded access to their gold market so that the Shanghai market has the ability to truly compete on an international basis. But I like the idea that we have 6 or 7 different trading facilities with 6 or 7 different market protocols. I think that the market should allow people to pursue their own interests with multiple service providers. And an exchange is merely a service provider.
Mm-hmm. Yeah, definitely. Okay, yeah, appreciate your thoughts on that. So let's jump into some money making tactics, and so let's see if I can unlock some of Rick's secrets on this interview. I notice sometimes when I interview you and I ask a certain question, I'm like, I think I unlocked one of Rick's secrets. So let's see if we're able to get into that.
China building a parallel gold market is more than a trading story. It could quietly change who gets to define gold's price. According to Rick Rule, competition against COMEX and LBMA can make price discovery less concentrated, especially if physical settlement becomes more important. The overlooked issue is whether Western paper markets remain dominant when physical buyers gain alternative venues. That matters because your portfolio can be priced by financial contracts, while the underlying metal becomes increasingly scarce. Next, Rick Rule reveals why the structure of the gold market may matter more than the headline price.
So, based on my years of interviewing you, one thing that I've noticed, and I've mentioned this in multiple other interviews and conversations I've had with investors, is that you typically sell when price is getting euphoric.
Yep.
And then you buy when prices are depressed. We talked in Boca Raton. You said, "Hey, I'm going to be buying gold." Gold was at 4,000. So now gold has risen another $300, $400. Curious if you are selling into this or if you are holding.
I'm about to get a pretty good paycheck from the conference. We pay all the expenses and stuff like that. I'm about to get a pretty good paycheck. And I suspect about half that paycheck will go into physical gold. And I'm pretty price insensitive, Daryl. I don't know what the future holds, but I don't suspect that any of this gold will find its way out of the market for 10 years, unless we have a liquidity-driven event where other asset classes really, really fall dramatically in price, and where the consequence of that is that my greed inspires me to sell some gold and buy some other kind of asset class. Absent that, absent a 2008 style event, it wouldn't surprise me if the sell decision for my personal gold was made by my heirs.
Mm-hmm. Yeah.
I consider gold to be an insurance asset, a savings asset, or in a sense, wealth itself. So I'm a systematic saver in gold.
Yeah,
there are times when, as you suggest, there's excess liquidity on the downside, which is to say there's a rout of selling. And in those circumstances, I front end my savings, which is to say I shift other savings assets, say U.S. dollar denominated savings assets, into gold. Out of, if you will, a current paycheck rather than a future paycheck. But normally I'm merely a systematic saver, which is to say whenever I experience a liquidity event, some or sometimes a substantial part of that liquidity goes into gold.
Mm-hmm. Okay, so I didn't preface this question. I'm referring to the equities. Okay. I know gold is money. That's our insurance policy.
When an investor stops caring about whether gold rises next month, the entire meaning of owning it changes. What Rick Rule is highlighting is not a price target, but a behavior, systematically converting liquidity into physical gold and treating it as wealth rather than a trade. That approach directly challenges the Wall Street obsession with timing every move. For long-term savers, patience can be more powerful than prediction, especially when monetary policy remains uncertain. Next, Rick Rule exposes when even disciplined gold holders become opportunistic buyers.
So with the equities, right?
I apologize. I misunderstood the question.
No. I didn't clarify it. But I just said gold. So equities they've fallen dramatically, and then we've had a big rally. So I think I was buying Wheaton at $104.
Yep.
It's run up to about $135. and many other equities. And so, is that something you like? What I've noticed over time is like even with uranium, hey, the price is getting too far ahead of itself. I'm going to sell some. Right. Are you seeing that with this recent rally?
You're not seeing enough euphoria in the gold stocks yet to have them be a trading sell. I will say that I am beginning to emphasize smaller, riskier stocks now. Partially the reason for that, Daryl, is, I'm 73 years old. I already own a lot of Franco and a lot of Wheaton and a lot of Agnico. And when you see increases in price like this, any generalist money that comes into the space goes into the best names. I believe, and I think we'll talk about this later in the interview, that we're coming into a real strong M&A market. And so I'm trying to use some of my money more speculatively than I did last year or the year before, trying to anticipate some of these M&A targets and trying to buy them. In other words, I'm becoming right now more speculative, not because at age 73 I should be more speculative, but rather because the investment part of my portfolio is pretty full.
Yeah. So there's a lot of fear that the Fed could hike rates. I think there was a couple of big institutions that gave a 30% chance of a rate hike before the past Fed meeting, and they decided to hold rates. There's also the thought around, if the Fed hikes rates, it's going to make it very expensive for the United States government, which is already at a huge deficit and such.
The strange part of this rally is that the biggest opportunity may be hiding outside the stocks everyone already knows. Rick Rule's argument suggests that when large investors enter a sector, capital initially concentrates in established names, potentially leaving smaller companies overlooked. That creates a different risk profile. Investors chasing yesterday's winners may miss the companies positioned for consolidation. If M&A accelerates, valuation and acquisition potential can matter more than broad sector momentum. Next, Rick Rule reveals why the strongest gold stock move may come from companies Wall Street barely watches.
Do you think this is some type of game that's being played, to try to trick investors, the Fed's going to hike rates? Do you think the Fed could hike rates, and would that cause some damage? Curious in your thoughts on that.
I don't think they're smart enough to trick anybody. I think there's a discussion going on behind the scenes from people who believe that the interest rate should be set by the market, and the political class who doesn't believe that the market should do anything, that they believe that they should do everything. When you listen to the policy prescription by the new Fed head, he seems fairly intelligent. The idea that the Fed shouldn't communicate with the market, that the Fed's intention shouldn't be something that causes the market to go up or down, the fact that ultimately the market should set interest rates. These are all beneficial ideas. The idea that either the economic oligarchs or the political oligarchs would allow this to happen in isolation without taking into account their interests, I think is problematic. I think, too, unfortunately, that the vast majority of American voters are more concerned about the level of their car payment and whether or not they can buy a house than they are the overall strength of the economy or the fact that debt and deficits are really stealing from our children's future. Most voters, I'm afraid, are more concerned about their own present than they are their children's future. The consequence of that is that there's a lot of political pressure to continue government spending and to have artificially low interest rates.
Mm. Could you see something like some yield curve control? So we see the long end of the curve continues to put pressure on a lot of dynamics, but we know historically the Fed comes in and buys the government debt, backstops the government, and typically tries to suppress interest rates.
The real Fed problem may be that markets eventually refuse to believe policymakers can control the price of money. This is where Rick Rule's thesis shifts from rate speculation toward political incentives. Voters want cheaper borrowing, while deficits make genuinely market-set rates increasingly painful. That creates pressure for intervention, regardless of what officials publicly promise. Investors should therefore watch long-term yields, not just the Fed's headline decision, because that is where credibility gets tested. Next, Rick Rule unravels what happens when the bond market stops cooperating.
So do you see that being like the ultimate case for like gold to go a lot higher?
If they fail, absolutely. I think what you're seeing on the long end of the yield curve is the market beginning to reassert control over the Fed. The Fed has been printing short-term paper and using the proceeds to buy the long debt. But that application of proceeds hasn't been sufficient to reduce long-term interest rates. The Fed has still managed fairly successfully to constrain artificially short-term interest rates. But it would appear that they've lost control of the 10-year and the 30-year. It's instructive, I think, that when the United States assisted Japan in defending the yen a couple of weeks ago, that what the United States government did was print U.S. dollars and lend them at very, very low interest to the Japanese, so that the Japanese could buy in yen without selling Japan's own hoarding of U.S. treasuries. The Japanese have $1.6 trillion in U.S. treasuries, and rather than selling those treasuries for U.S. dollars and using that to defend the yen, the U.S. government lent them newly issued U.S. dollars. That says a lot about the Treasury's concern for the float on U.S. treasuries and the aftermarket for U.S. treasuries, given the printing needs of the U.S. government. And those aren't pleasant thoughts.
Mm-hmm.
I'm also personally friends with Rudy Frank, who runs Seabridge. One positive around Seabridge, it's huge. It may be the largest undeveloped gold project in the world. And an acquirer that comes in has solved his or her depletion problem for a decade.
Mm-hmm. Yeah.
And these big majors have a depletion problem. It's one way to solve a balance sheet problem for a very, very, very long time. The bad news is capital intensity. There's extraordinary upfront capital cost to build that thing. I suspect that the feasibility study needs to be updated because there's been substantial inflation in construction and other costs. And Rudy has signaled to the market, including at our conference, that they're down to one bidder, which is to say he's talked with the 12 or 13 companies that have signed confidentiality agreements, and he's agreed to engage in exclusive negotiations with one.
The Fed can control overnight rates far more easily than it can command investors to buy 30-year debt. As Rick Rule notes, the long end is where market resistance becomes visible, particularly when policy intervention fails to compress yields as intended. That matters because persistent long-term pressure can raise government financing costs while simultaneously strengthening gold's monetary appeal. For ordinary savers, this is the uncomfortable scenario. Policymakers retain influence over short rates while losing credibility over long rates. Next, Rick Rule exposes why Treasury market stress could reshape gold valuations.
It's very difficult to have an auction with one bidder.
Yeah.
There's no deal tension with one bidder. And I suspect that at $5,500 gold, that bidder would have to have been aggressive, because at $5,500 gold, you amortize that upfront capital expense much more quickly than you do at $4,400 gold. So I think the pressure is off the acquirer as a consequence of softer gold prices. And it wouldn't surprise me, although Rudy Frank believes, I think, that the Tudor Gold litigation isn't particularly an issue. I think that the acquirer, given that there's only one in the line, and given that gold is currently at $4,400, has the luxury of allowing Rudy and Tudor to work out that difficulty as opposed to them having to work out the difficulty themselves. you should probably interview Rudy. He's a very smart guy, and allow him to contest what I just said, which I'm sure he'll do very vigorously. But I think the bottom line here is that at $5,500, time is on the side of Rudy. At $4,400, given that there's one bidder, time is on the side of the bidder.
Yeah, I can see that. Those power dynamics and leverage dynamics shifting there.
A falling gold price can quietly strengthen the buyer's negotiating position, even while making the underlying asset more valuable strategically. According to Rick Rule, the difference between $5,500 and $4,400 gold dramatically changes how quickly a major can justify enormous development costs, especially with only one bidder. The hidden variable is leverage. Higher prices favor the seller, while softer prices give an acquirer time. Investors should watch deal structure, not just metal prices.